Hey guys, Whitney here. Thanks so much for joining me today. I'm just going to give it a couple minutes for people to join us live. All right, guys, thanks so much for joining me tonight. My name is Whitney Elkins Hutton. I'm the Director of Investor Education here at PassiveInvesting.com. And tonight we are going to dive into the multi-generational wealth blueprint. We're going to cover principles on how to make money, keep money, invest money, and pass wealth on to the next generation. As we go through tonight's materials, I know a lot of people are watching this live, but there are also going to be people that are watching this recorded later. Put your questions into the Q&A box. That way I can make sure to cover people's questions during the course of the material. And then we'll hang out here a little bit at the end and get additional questions cleaned up. I've allowed us 2 hours to cover the material. I don't think it will actually take us that long. But again, I wanted to make sure I allowed plenty of space for us to get through this material. All right. So if you don't know me, my name is Whitney. And again, I'm the Director of Investor Education here at PassiveInvesting.com. And this is the whole reason why I learned how to invest passively. This is the whole reason why I got into real estate, is because of my crazy crew here, my husband and daughter. I actually started off as an accidental investor in 2002, bought a house with a significant other, and it quickly, that relationship quickly unraveled, and everything was under my name. And to be quite honest, I was pretty scared on what to do. Fortunately, I was young and didn't have many responsibilities, so I just stuffed the house full of roommates. Completed the rehab on the house myself, and I was bitten by the investing bug after that, because when I sold that house 11 months later, I was able to turn a $52,000 profit, which was just a hair under what I was actually making in my day job that was costing me to travel, probably 3/4 of the time. But I was working about 80 hours a week. I love my job. But also I, saw a path to hit financial independence and financial freedom. What I didn't realize at that time is that I had found a strategy, but I was still missing a lot of principles on how to actually really impact and change my life. And that is what tonight is all about, is me just sharing these principles that I've learned over the past 20 years of investing. Some of the, pulling in information from a myriad of sources of, people you probably know really well, but helping you kind of put it together in a holistic plan. That way you can actually execute and create a blueprint for yourself. All right. But over the course of the investing, I've done active investing. I've also done fix and flipping. I've done house hacking. I've done passive investing. I've been general partners in several multifamily deals. And really, where I'm at today is that my husband and I, we have over 6,300 multifamily units under under management. Some of these active, some of these passive. We also have 1,400 self-storage units, 9 car washes, a hotel, and various other business. We also have a camper van business as well. So anyways, this is where we're at. But really, what we're here to talk about tonight is, again, that experience that I have. And I've had the unfortunate experience of settling 3 probates, 2 trusts. And, between those 2 between all of those estates, I've actually have the unfortunate experience of my family losing over $700,000. And this is to not having good planning, either at how they earn their income, how they keep their income, how they invested their wealth, and then more importantly, how they plan to pass it on to the next generation. Now, $700,000 to somebody who has like a large portfolio, it might seem annoying, definitely painful, like nobody wants to lose that. But that has actually potential power. And when you, just compound that out over 30 years, the potential power that it's lost in, in the case of my family for, as these estates settled, losing that $700,000, is that if you compound that out over 30 years, at just a 7% return, that's a $5.3 million loss to our family's earning potential over time, our wealth plan. And so I want to help you now. Hopefully, you don't suffer, any type of losses that, my family did. I want to help you sidestep and avoid those wherever we can. However, this can be huge, right? This can, how I view it for myself is that I am a transitional character for my family. And maybe you're that for your family too. Now, what is multi-generational wealth? Well, multi-generational wealth is not just understanding what to do, it's actually doing it. So we're gonna, go over again the principles of how to keep wealth, or excuse me, how to create wealth, how to keep it, how to invest it, and then how to pass it on. But also give you some tangible things to take advantage of and to really execute on, concrete steps that you need to take. And so take notes. You're going to get the recording of this as well, so you can actually go back and rewind, look at it again, like once a quarter until you got these principles down. And this is something that I'm hugely passionate about. But again, why should we really care, right? It's not all about the money, right? It's not the potential loss of money. That's really not, what this is all about. Is that when you have a good financial plan, when you have a good multi-generational wealth plan, you get to reap the 5 freedoms of life: financial freedom, time freedom, freedom of choice, freedom of location, and freedom of impact. And that, my friends, is what I'm after for myself. Okay. Disclaimer, I always have to put out a disclaimer. Anything that we talk about in today's presentation should not be construed as financial advice, tax advice, legal advice. Make sure you take this all back to your team before you make any sort of large decision or even an investment decision. Okay, let's dive in with our first topic: how to create wealth. So the first step in learning how to create wealth, and I would imagine a lot of people here actually have heard of Robert Kiyosaki, maybe even read Rich Dad, Poor Dad, or The Cash Flow Quadrant, which is personally one of my favorite books by Kiyosaki, is that we actually have to understand how to shift our income. Take it from like being linear, where we're trading time for money, and then learn how to make our money make money, right? Exponential growth. Okay, essentially learn how to create an income for ourselves where our time is no longer attached to that. So this is a drawing or a visual out of Robert Kiyosaki's book. It's in Rich Dad, Poor Dad, but again, I think in Cash Flow Quadrant, he really expands on this concept. And it was that book that I read that really hit home for me. And that is, if you're earning your income, trading time for money, like working a job, W-2 job, that if you're trading your time for money, you have a job, right? There's really no leverage. You might have 1 or 2 employees underneath you. That allows you to be more productive, and it may warrant a little bit of a bump and increase, but a lot of that increase comes with responsibility. All right, so it's challenging. You're going to be an employee if you remain in that category. Now, a lot of people are like, man, I was just even talking to an investor yesterday. She was just like, I'm stepping away from my full-time business. My husband's taken, her full-time job. Her husband is stepping away too, and they're going to start a consultancy practice. And they were like, why should we take our expertise and, make somebody else money? Why don't we make our own selves money? Well, okay, that's fantastic. But when you start, stepping in that type of role, again, we're progressing, we're growing, but now we own a job, right? We're now self-employed, okay? A lot of people that fall in this category are doctors, lawyers, chiropractors. There's nothing wrong with it. However, self-employment is actually the largest taxed category. Okay, the news would have us think that it's actually being an employee at a W-2 job, but no, it's actually self-employed, because now we have to pay the self-employment tax, 15.3%, in addition to what we were paying as an employee. All right. So really what we need to learn how to do is shift our income over to this right-hand side, okay? Be it into owning our own business, Okay. And I mean, not like 1 or 2 employees, I mean like 30, 40, 50 employees, where we can actually, our business grows through a system without us being necessarily involved. We can just be a strategist over that. Now, not everybody has the desire to do that. All right. And a lot of people are like, man, that just sounds like a lot of hard work. I'm not sure if I have the skill that would warrant building a large business. Do I want to go back and acquire a skill to build a large business? Is there another way that I can actually unhook my time from how I make money? And that is the beautiful part. Yes, you can. And that is becoming an investor, where you make your money work for you. You have true passive income. Now, it does require you, from, if you're making money actively, to convert that into passive income as quickly as you possibly can. Okay, and as often as you possibly can. But really, when we talk about how do we create wealth, that is the first step, is understanding this principle of linear versus residual income. All right, now, but that's only one piece of the puzzle. We also have to learn how to create what we call a rich balance sheet. Okay, and that is, nobody likes the word budget. Budget seems to, give a connotation that, I'm restricting myself in some form or fashion. Really, what we need to learn how to do, and again, this is taken from Rich Dad, Poor Dad, Robert Kiyosaki's first book, is that we need to learn how to have our assets produce income that cover all of our expenses, okay, and our liabilities. So our assets are generating income. But what most people have actually is the income in the middle class, where we have a job, we get a salary, we have a bunch of liabilities and expenses, but our assets aren't actually offsetting our income. Guys, I'm going to pause just for a second. I have an air conditioner going in my room. And anyways, long story short, it's very loud now. Okay, hopefully that's better for you guys. So, but this just gives a visual on how a lot of people kind of progress through life. They might start, they get a job, they earn a salary, and then they have some expenses, but they don't have any savings to actually acquire assets. And then as you get, older, and you like maybe buy a house, buy a car, maybe buy a second house, now you're getting more liabilities, okay, and expenses, but you haven't really made yourself rich, okay? It's really when we're, again, able to take that active income, convert it into passive income as quickly as we possibly can, okay? Passive income through owning our own built business, where we are just a strategist, or actually being a passive investor in somebody else's business, that when we have enough of these assets that produce income to cover all of our expenses, that's when we're going to be financially free. That's when we have a rich life, right? Again, this is part of 1 to 2 principles in how do we create wealth. All right. Now, once we create it, we now have to learn how to keep it. All right. And then, so how do we do that? Is that we actually have to learn how to eliminate the 4 horsemen hiding in our portfolio, and also learn how to protect our assets. All right. So the first thing, there's 4 horsemen. Okay. The first one is interest. Okay. We need to learn how to not only not pay interest, okay, but also how can we make interest work in our favor? Now, most people get really attached to, how can I get a credit card with the lowest interest rate? How can I get a home mortgage loan with the lowest interest rate, or car loan with a low interest rate? If you're watching the news these days and you're seeing all the inflation and recession numbers, you're seeing the Fed raise the Fed fund rate, mortgage rates, are going through the roof. You would think the wheels are coming off, and that's actually not the case. What we need to do is have effective interest in our life. Okay, so if you own assets, say like a rental property or something like that, we can actually measure how effective that interest rate is. You can even apply this to your credit card bills and your car loans. And essentially, we want to take the cash flow, or we're going to calculate a cash flow index. We're going to take the loan, the math is take the loan balance divided by the minimum monthly payment, and you're going to get an index number. Okay, that's step 1. Step 2 is that you need to then take that index number and drop it in one of these categories. All right. If that index number is 50 or less, that's going to be really inefficient debt. This is where you're going to have your credit card debt. You're going to have your, maybe like car loan debt, something like that. Okay. You could have house debt on your property or a mortgage debt on your property. That's pretty ineffective. Okay. It's not just restricted to the car loans or anything like that. Now, if it's between 50 and 100, we're just going to push pause. Okay. That warrants us potentially restructuring that debt through like a refinance or something like that. Okay. Or pulling the equity out and having that equity do a larger job for us. And by that index is 100 or above, that's what we kind of call the happy zone. That is really efficient debt on whatever that particular asset or, maybe it's a HELOC on your house. A lot of times people are really nervous of using debt, but again, we want to make sure it is efficient debt. All right. I don't know if anybody here is like a follower of Dave Ramsey. If you follow him, I think, his methodology is fantastic for people who are just underwater with all the different types of danger zone debt. But debt can be used properly where we can actually use it to build our wealth. And this is the number that you want to pay attention to. Now that's horseman number one. Horseman number two is investment fees. This is huge. I mean, absolutely huge. Now, there are some low-hanging fruit when we talk about investment fees. Maybe you have a bank account and you're paying an account maintenance fee of like $6 or $10 a month. Maybe you're paying ATM fees, $3 to withdraw like $100. Those type of fees are annoying. And yes, they can erode wealth, but they're not going to be the largest movers within our portfolio. To step it up a little bit, you might have credit or loan fees. Maybe you have like single family property or small multifamily property, or you are carrying large credit card debt, and you have recurring fees on this type of debt. That is, if you can eliminate those type of fees, again, that is going to be even more impactful. Now, the real horseman lying in secret in most people's portfolio is actually the fees that are attached to retirement. Okay, so maybe you've got a 401k or an IRA or a Roth, and depending on who it's with, you might actually be paying a little bit of fee or quite a bit of fee. Now, this graph is pulled from one of my most favorite tools called personalcapital.com. You can go create your own free account there. And but anyways, I love that because it really made it gave me a good visual on how fees were impacting my portfolio. Now, in this particular assumption, I'm assuming this person is contributing for 25 years and they're maxing out their 401k at $20,500. Okay, now that's like, it might have gone up this year on what you can contribute. So if it did, we're off a couple $100. Okay, we're still good, but they're maxing out their retirement portfolio. They're receiving zero match from their employer. Okay, so this is that. I wanted to make sure that we looked at it with the zero match, so we weren't clouding the issue here. Now, because if it's matched, actually the losses are greater. All right, but we're not going to cloud the issue. We're going to assume that there's just zero match. Now, in this particular portfolio, the compounded growth is 7% for 25 years. Now, I actually modeled this out at a modest 1.5% total aggregated investment fee. So that assumed say like 0.4 to 0.5% expense ratio for any asset that's in their portfolio, as well as a 1% fiduciary fee that is being passed through from their employer, right? Or from like their company they're investing with like Ameriprise or Vanguard or something like that. Now, this is modest, I tell you guys, all right? 1.5 is probably the minimum amount of fee that most people are paying within their portfolio. Doesn't sound like much, does it? But look at what happens over time. Throughout that 25-year period, they're losing over 31% of their portfolio minimally to free fees, all right? And that's just assuming that the market clips 7% growth compounded every single year. There are no down years, there are no missed years. Okay, we can't say that right now, correct? Now, a lot of people are, might be saying, hey, I do my own investing. Okay. Forget that 1% fee from Vanguard. I do everything on my own. So all I have is the expense ratio. Fantastic. You're still losing 11% of your portfolio to fees. All right. I don't know about you. When I saw those numbers and started modeling it for myself, that's when I really was, I just knew that I had to actually take the bull by the horns and learn as much as I possibly could about investing, and take that money back for myself. Now, this is where, I like telling stories, and hopefully we have enough time for me to tell a couple stories, but this is really, it was kind of the tale of two grandfathers. I had one grandfather that, did just that. He at age 80, he decided to kind of take the bull by his horn, learn how to invest all on his own. In the stock market, he still had his cattle, he still had his businesses. He invested in real estate, he invested in notes. Then I had another grandfather that actually took everything and, put it with a financial advisor. I will tell you the difference between what they ended up with, at the end of life, we're talking in their 80s. My one grandfather that took the bull by the horns, he died at 98. It made a $1.6 million difference, okay? He got paid to learn, for sure. All right, the third horseman that's probably lying in secret in your portfolio is insurance. Now, it could be you have too much, not the right kind, maybe you're overpaying, or maybe you don't have enough. But let's just kind of like level set the playing field. Insurance, the goal of having insurance is actually to outsource liability, all right? To shift liability from you onto a company. Should something catastrophic happen, you're not responsible for it, but that company is responsible to pay. Now, when we look at insurance, I have a few ground rules in order to kind of point you in the right direction. First, don't overpay for insurances, okay? I know a lot of times whenever I'm working, personally coaching people, I often find that they're paying double, triple, sometimes 4 times the market rate because it's a friend or a family friend, or maybe even a family member. Okay, you don't have to overpay for insurance. Okay, the insurances do add up. Also, don't pay for junk insurances. If you don't need it, don't pay for it. Okay, get rid of the policy. Also, make sure that you don't have duplication of policies. A lot of times I'll find that people have like multiple life insurance policies that are term life insurance policies, and there's no cause for them to need them. Or maybe they actually have like, multiple like renters policies, or, ill-structured car policy. Now, I'm not an insurance agent, but whenever you learn the basic principles about insurance and what you need to have, and to really truly outsource your liability, it's very eye-opening. So what do you need to have? Well, make sure that you have health insurance. That's probably one of the top 2 ways you're going to leverage any sort of insurance policy. It's going to be through your health, or it's going to be through your car, something happening with your car. So make sure you have good, adequate health insurance coverage. Disability insurance. I really encourage people to have some sort of disability insurance in case you are injured and can't work anymore, or you can't perform your profession anymore. And that's actually 2 different types of insurance there. And you can actually get those coverages combined into one policy, work your job or work any job. You can actually get disability insurance for that. You're essentially protecting, outsourcing liability for you not to be able to work again. Your house, your home, make sure that you have adequate home and renters insurance, and visit those policies every couple years to make sure they're up to date. I live in Boulder, Colorado. On December 30th, this past year, we had a horrific windstorm. And during that windstorm, a fire broke out on public lands. Okay, we're still trying to figure out the origin. It burned 6,000 acres in less than 8 hours and leveled 1,100 homes in our community. All right. Majority of those people hadn't touched their insurance policy in 3 to 4 or 5 years. And we all know what happened during COVID. Labor rates went up, supply, cost of supplies went up, and it's really difficult for these people to rebuild. All right. And this was an urban fire, right? This was not in the mountains or anything like that. So make sure you're revisiting. It can, the disaster can come from a flood or something like that. Again, the point is not to pay the lowest insurance, it's to pay the right amount of insurance to outsource your liability. All right. Make sure you have good quality coverage on your auto insurance policy, that you have good liability, that you have good medical coverage, med pay on that policy, and you have good coverage for bodily harm, should you be harmed or accidentally harm somebody else. I also encourage people, because of this windstorm, we actually had an incident where that windstorm picked up our little 14-foot trailer and blew it into our neighbor's car. Our neighbor actually did not have comprehensive insurance on his car, and our insurance company would not pay because he did not have comprehensive insurance. So that that's something else now that I'm kind of adding to my checklist and really trying to help coach people on. If you can afford it, make sure you have comprehensive insurance on your car. All right, now that you've got the basics covered, those first 4 basics, look to get a personal umbrella policy, because that'll help coordinate all those 4 policies together and fill in any gaps so you have adequate coverage. All right, and then after that, take a look at life insurance policy. Depending on where you're at in your life, it could be a term policy, or it can be like a whole life policy. I personally love, initially starting with term and then transitioning into whole life whenever you can start building what we call a cash flow life insurance bank for yourself. And I actually did a webinar probably about 6 months ago with Chris Larson, demonstrating how that can be a good, effective way for you to have not only a life insurance policy, that you can use to pass on to your heirs, or as some coverage for end of life, but also as a way that you can build up cash value and actually supercharge your investments. All right, if you guys want that link, make sure to reach out to me. I'll give you my email at the end. It's whitney@passiveinvesting.com, and I'd be happy to share with you that episode. All right, so the 4th horsemen living in your portfolio are taxes. Now we're going to talk about some basic things, and then I'm going to kind of go to a really high level thing that I know when I talk to a lot of investors, they don't even have the eye on the ball. They're not even looking at it. Okay, so this is a great book. I highly suggest this book. It is Tax-Free Wealth by Tom Wheelwright. Now, he also, if you can find it on the interweb, he actually has for those people who are like, no way, I'm not going to read, the end-to-end book from Tom Wheelwright. He also has a PDF called 5 Simple Steps to Eliminating Taxes. And anyways, it's really eye-opening, because for us, we're really trained. I know for myself, I was trained growing up to actually, unfortunately, pay taxes, and I didn't even know it. I know for myself, I was trained to start, when I get a good job, get a good education, get a good job, start saving for my retirement, right? Start stuffing money in my 401k and IRAs as quickly as I possibly could, max them out every single year, sit back, wait 30, 40, 50 years, and voila, I can retire. Okay. That I saw very quickly about 15 years ago that there was just no way, when I was watching my grandparents and what they were going through with their end of life issues, it was just there's just no way this works for everybody, and it doesn't work in every time. So how can one win? Well, when I found this document, it was very eye-opening. Step number 1, make sure that you're taking all the deductions that you possibly can. For us, if you're here, you're more than likely investing in real estate, whether it's actively or passively. Make sure you have a business. Make sure you're taking all the deductions you can, and that you're taking all the depreciation you can to build up those losses. Number 2, learn how to convert your income using entities. People who own businesses, remember we looked at that cash flow quadrant. on the right-hand side, those who are investing in businesses and investing as an investor in somebody else's business, they get the best tax breaks, right? We talked about the number one tax category is actually the self-employed person, the one that has kind of the solopreneur type business. So look how you can convert income using entities. Number 3, I love whenever I do this presentation live because I get to be in a room full of people and I get to ask questions and I can see their hands go up. But learn how to shift income to lower tax brackets. This could be one of my favorites is employing your kids. If you have kids, you should be employing them. They should be taking some sort of role in your business. We started employing our daughter as a model at age 3. And we could pay her for that. Now we had to follow the IRS guidelines for, write her a job description, actually, 1099er. But we were able to shift income to her. Another great way to shift income is if you have any other dependent, living with you, maybe it's a parent that you're taking care of. You can actually, if they're retired, you can shift income the other direction and put them to work in your business, okay? Also, number 4 is learn how to eliminate income through credits, right? This is, I don't encourage people to let the tax dog wag or the tax tail wag the dog, so to speak. But this is something you should be partnering with your CPA, partnering with a professional about, and making sure that you're taking as many credits as you're entitled to, because that is dollar for dollar off your income, okay? There's no proration or anything like that. If the tax credit is $5,000, that is $5,000 directly off your income. And then, once you're working with your professional, once all of that is taken into account, defer your income. But unfortunately, for us, I know for me growing up, I was actually trained to start here, okay? And as for many, just if we're only earning income through W-2 employment, for many of us, that's the only thing that we can do because we don't have any other sort of business enterprises or activity to where we can take advantage of these other 4 steps. Now, I did put an asterisk in here because I would, if it were me and I were rewriting this pamphlet, I would actually add in a step here. Once you got all this down, now learn how to play the step up game. And what I mean by that is acquiring assets, keeping them in your name, not giving them to your heirs or gifting them to your heirs, keeping them in your name, and then die with them. Okay, you literally pass on, and then they get your heir, you get the asset. And because right now we have the step up and basis ruling in the IRS tax code, where a lot of assets can actually pass on to our heirs tax-free, or they can get the step up in basis and pay no tax. So that is something that you should be partnering with your professionals about as well. All right. So that was a lot to digest on taxes. Again, I'm not a CPA professional. Make sure you take this information back to them. But there's one other thing here that I think a lot of people are unaware of, especially if you have a 401k or an IRA account. And that is, you need to get very comfortable with the term called provisional income. All right, so provisional income, okay? This is where somebody is trying to qualify to get Social Security, all right? And there's only 3 assets out there right now in our tax code that do not trigger provisional income. Number 1, a Roth IRA, okay? That's a vehicle, it's not the asset, okay? But anything in a Roth IRA does not get counted against us. When we start withdrawing income from the IRA, it does not count against us in the calculation of our Social Security. Cash flow life insurance, if you start taking loans against your cash flow life insurance policy, that does not count against you either, right? It does not trigger the provision income rule. And in your IRAs, as long as your required minimum distribution is below your standard deduction, okay, for a married couple right now, it's around $25,000 a year, that too does not trigger provisional income. All right. However, everything above that does. And what happens when that provisional income is triggered is that we actually get double taxation of Social Security. So in the end, what's happening with people's IRA accounts whenever they get to the point where they want to start taking income is that they've been stuffing money in there. It's amazing. They've got 500,000 or a million or 1.5 in there. They have compounded growth, but they also get compounded taxes. All right. Now, this graph here is taken from David McKnight's The Power of Zero book. And I really encourage you to take a screenshot and take this. If you are predicting you're going to be retiring with $500,000 or more in your retirement accounts, which most people are, I would imagine, that you get to know this term very well and start talking to your accounting team and tax strategists on how you can avoid this. All right, so those are the 4 horsemen: interest, investment fees, insurance, and then taxes. Now, I also encourage you here on how to keep wealth is you need to learn how to protect your assets. Now, this is tongue in cheek, guys. All right, I have to be kind of a little bit funny here, but take a snapshot of this. When I'm looking at my own way of how I'm going to protect my wealth, I want to make sure that I have a living will in place with health directives and powers of attorney. Okay, base floor. Why? Is because this guards against my health, any health issues draining my accounts. Okay. I actually had a family member fall ill, and they fell ill with no living will and no health directive and no power of attorney. Unfortunately, her spouse was unable to do anything, and had to kind of go through the court system to be able to help her with planning for end of life. In a matter of 6 months, they had a very comfortable retirement. And then at the end of 6 months, they pretty much drained every last dollar in every single account supporting her end of life. Okay, make sure that you have these things in place. That way you're empowered and your family's empowered to help at this type of, should there be a disaster or end of life issue. Number 2, put together a living trust with pour over wills. Especially if you have kids, if all you have is a will does not provide for care of your children. Okay, guys, not a lawyer. These are just things I've learned through working through these 3 probates and working with these 2 trusts, and also setting up my own strategy. Also, the living trust and pour over will also guards against me being, forgetful should I not move an asset into the trust entity. All right. I don't know how many times I've talked to people, talked to investors, and they're like, "Oh yeah, I got a trust," and I'll just double check. I'm like, "You got everything titled to it, right?" And they're like, "What? You got? Oh no, the cars are in my name. The house is in my name. No, you got to actually move the assets into the trust in order for this to work, or have a pour over will that upon your death, everything automatically would go over into the trust. It's better if they're already named in the trust, but the pour over will is kind of a catch-all. Number 3, cash flow life insurance. Okay, I am a big proponent of this and big advocate of it. I'm not trying to sell you on it. However, I look at it is that it guards against me totally messing up as an investor, right? If I get to the end of my life and I have lost on all of my assets, as long as I can maintain this policy, my daughter will get an inheritance. Plain and simple, right? I'm going to still be able to impact my family's wealth building. And then number 4, the execution of what I call the CYA plan. And we're going to talk about that in our last step. All right. Now, let's talk about how to invest well. This is probably what most people are here for. I'm going to go over the 4 pillars, the 2 amplifiers, and the 3 assets for you to be looking at. This is a really long section, so if you need to stand up and take a break, do so. But you've probably heard me talk about this several times before. I try to thread these 4 pillars into all of my talks some way or another. Repetition is the mother of all skill. But if you have not heard of them before, I call them the 4 tenets of conservative investing. Whenever you're investing, make sure you have capital preservation, cash flow, equity growth, and there's 3 different ways you can get equity growth. Ideally, you can get all 2 or 3 of those and get tax benefits. Now, if you guys aren't familiar with who this is Warren Buffett. He has 2 rules of investing. He has many rules than that, but the first 2 is never lose money. And rule number two is see rule number one. Okay, that's how important it is not to lose money. So how do we do this? Well, number one, make sure that whatever asset you're investing in is actually secured by a hard asset. Okay, not a paper asset, but a hard asset like real estate, like a business. Make sure whatever asset you're investing in has a valuation on either based on the net operating income that it brings in or on the expected gross income that it's bringing in. Again, we're looking at real estate or businesses here. I would add like a little caveat in here is that make sure that if whatever you're investing in, and this goes for real estate businesses, whatever investment, okay, this is across the board, that there's a comparable higher than the subject asset. So if we're talking about multifamily, we're not buying the best multifamily property or the highest priced one in the area, right? That we're below market or below the top dog. And then number three, make sure that there's enough reserves to maintain the asset for a set period of time, 6, 8, 12 months, right? And those reserves should be able to cover CapEx as well as operational reserves. Now, the reason why I love looking for strong reserves on property, it's not so you have a ton of cash lying around and being ineffective. It's just if I don't have to sell an asset, or if the operator does not have to sell an asset in a down market, they can actually hold on and weather whatever storm's being thrown at them. That's a bonus. Okay, we can actually ride it out. We will not have lost money. We can ride out the storm into the next up cycle. All right. Pillar number two, cash flow. A friend of mine, Ryan Lee, from Cash Flow Tactics, actually tells a story about cash flow, and he illustrated it this way. He's like, when you can invest in trees, but not all trees are the same. He goes, you might be able to invest in a forest of trees that where the ponderosa pines, they grow so tall, but if you want to get wood out of them to build a home or paper, create paper, you got to cut the whole tree down and wait another 150 years for that tree to grow back. Or you can invest in an apple tree, something that produces fruit on a regular, consistent basis. You still have to maintain the tree. You got to groom it. You've got to feed it. You might want to plant an orchard of them, but really that apple tree, once you get it up and going, it's producing cash flow regularly over time, and you never have to cut it down. So I like that analogy because, what I look for is investing in an asset that has multiple units of cash flow, and ideally that is cash flowing today in today's environment. I don't have to wait 6, 8, 9, 12 months in order for it to ramp up and get the cash flow. It's cash flowing now. Okay, it's stable now. Also, when we look at cash flow, I want to make sure that there's a business plan on the asset to increase the cash flow. Okay, pull the net operating income levers or the expected gross income levers. And we're going to talk more about that in the next slide. I want to make sure it has a low break-even number. Okay, meaning that I can actually see a decrease in the income on the property. Okay, maybe it's through occupancy or customers, but that I can experience a drop in that occupancy or in that income, and I can my expenses are low and they can still all be covered. All right, I don't want to have to maintain 80% occupancy because my expenses are at 75%. I would like to see my expenses like at 35, 45, 50%. And maybe I only need to have an occupancy of 65% in order to cover that. I can go down to historic vacancy numbers and still make money, and not lose the asset. And then number 4, make sure that there's enough reserves to maintain the asset. All right, pillar number 3, make sure the asset has equity growth levers associated with it. And these levers, there's 3 ways to earn equity in an asset, and there's multiple levers within each of these 3 areas. Okay, but number 1, market appreciation. That's just what does the market hand you? So look for assets that are in growth markets, that they're in the path of progress, and that there's room to grow, meaning that there's comparables above, sale comparables, rent comparables, income comparables above what you are looking to achieve. Number 2, forced appreciation. So this is where I, as the operator or the operator that I'm investing with, actually gets to pull levers to increase the net operating income or the expected gross income in the asset and drive the value of the asset. It can be through increasing income, decreasing expenses, or adding additional streams of income. And the power is really powerful when all three of those come together. And number three, being able to outsource the debt. Okay. Now, how we buy commercial properties, a lot of the loans that we're looking at are actually interest-only loans, but I get to outsource that entirely to the tenant or to the customer. But if you're like, held your own single-family portfolio or small multifamily portfolio, make sure that you can actually get some tenant pay down on those as well to add a little bit of additional equity. Now, the fourth pillar is tax benefits. Okay, I look for assets that give you depreciation, give you accelerated depreciation through what we call a cost segregation analysis. That is where we can send in an engineer on the project and they can break apart the asset, like a multifamily building or a self-storage building, into all the different components, like the walls, the foundation, the fixtures. Anything that breaks down, according to the IRS, in 20 years or less, we can accelerate that to the first 5 years of the hold. That's amazing for us, generating a bucket of losses that we can use to shelter income or shelter gains. Okay, we want to look for those type of projects. At least I do. Right now, we have 100% bonus depreciation. Okay, that is through the end of 2022. It starts fading out in 2023. It'll go down to 80%, and then, unless there's a tax law change, it will continue to phase out over time. We also have the ability right now, and I shouldn't say right now, this has been for a very long time, since the 1921, 24, to do a 1031 exchange. The 1031 exchange has been around for a very long time. I don't see this going away. But that is a way for us to continue to defer our depreciation recapture and capital gains as long as we stay invested in an asset, right? The government is very ineffective at business and providing housing for people. So for us as an investor, we get to help solve that problem when we get rewarded for it. All right, there's other ways to invest in or offset taxes with opportunity zones, DSTs, or lazy 1031 exchanges. I've done, webinars on all of those, but those are kind of more tactics. We need to master the basics. Now that we've got the 4 pillars down, okay, I will tell you from my family, nobody in my family really knew about that. Maybe one of my grandfathers did. But I'll tell you why, that even him knowing that was actually a failure for us here in a little bit. But for me, I didn't learn that until probably like about 10 years ago, halfway through my real estate investing career, did somebody just actually say, hey, it's really easy for you to invest your wealth and grow it. You just need to have like a set of investing principles and make sure every asset you go into adheres to these principles. Once I actually stripped that back and started investing by principle, that's whenever my growth really started to explode. And I'm going to show you how to put this into action here in just a minute. I'm going to show you a tool. But before we do that, I want to make sure that you understand the 2 amplifiers to growth. And this is really important right now in today's environment. Number 1, you have to pay attention to leverage. Okay. Make sure that you actually understand how the interest rate environment works. Okay. If I can put leverage on an asset, I can actually make money through somebody else's money. I can probably achieve a higher return. But I want to make sure it's the right kind of asset. The interest rate is, ideally is fixed for the term of the hold, if not longer. Now, or that if it is a floating interest rate loan, that there's a cap on it. Okay. You want to make sure any asset you go into that if it's using leverage, that there's a cap on that leverage and that interest rate cannot go higher. Additionally, you want to make sure that asset has been underwritten at the full interest rate cap. So let's say the interest rate is capped at, say, 6.5%, but right now it's 4%. Make sure that you're looking, or that the operator has actually underwritten for the lifetime of the asset at that 6.5%. That's what we call stress testing. Okay. I also want the debt, the leverage, to be for at least the life of the business plan, and ability to obtain extensions. I might have to pay for the extensions, but the ability to obtain extensions if I need them. The other amplifier is inflation hedge. Okay, I want to make sure whatever asset that I'm going into, there's the ability for me to adjust the income on a regular basis to respond to the market. Now, I'm going to show you kind of how to put these things into play, like I said, and I'm going to break this apart for you in the different assets, why some assets might be a little bit better inflation hedge than others. Okay. Or really, there's 3 assets that meet all these criteria, the 4 pillars and the 2 amplifiers, as you call them. One is life insurance, but I'm not a life insurance salesman or expert, so I'm just going to mention it, and I can put you in touch with people if you want to explore that further. But real estate and business, okay, those are the 2 those are the only 2 things that actually meet these type of investing criteria. And probably why you're here is like you're learning how to combine the 2 through passive investing in somebody else's business where the underlying core of the business is real estate. All right, so what assets in real estate am I liking right now? Well, a lot of them here that we have at passiveinvesting.com. I'm just going to go through this really quickly to show you how you can apply these principles to kind of do like an initial screen on whether this asset class is worthy for you to explore further. One, we got multifamily real estate. It's great at capital preservation. You know, I really like investing in growth markets where the population's growing, incomes are growing, jobs are growing, jobs are diversified, poverty is coming down, crime's coming down. All these things are working in my favor as an investor. Okay, I don't have to overcome a market, an objection in the market. The market actually works for me and helps shore up the foundation of the investment. I also look for investments, and this is across the board, not just specific to multifamily, where it's favorable tax laws. Specific to multifamily, I also want to look for favorable landlord-tenant laws. So the operator actually has leeway on how they work with the tenant, and it's not just a one-size-fits-all solution. Cash flow. In multifamily, right now, core plus assets are cash flowing very well and have a low risk business plan compared to other sort of more value add strategies or heavy value add strategies that are exposed to whose business plans have a labor exposure and a supply exposure. Hopefully those things will start leveling out over time. But right now, we're not really seeing that much of a difference between the type of return you can get on a core asset versus a deep value add asset. Okay. And more specifically, I should put in there the class too. So, stabilized suburban A-class assets, suburban B+ assets, that's really kind of where, I'm focused right now. Equity growth, I'm looking for multifamily projects where there's the ability to move rents to market rent, ability to create operational efficiencies, and add some additional streams of income to the property, again, to pull that equity growth lever, that pillar. Multifamily is great at tax benefits. Okay, we've got depreciation. It's a shorter depreciation schedule. I really like that about multifamily. You can take advantage of bonus and accelerated depreciation and 1031 exchanges. Now, here's kind of a key thing that I help people understand is just because multifamily qualifies for all these tax benefits doesn't mean the operator actually does them. Maybe they don't even do a cost segregation analysis. I don't know why, but I've run into a couple of people that don't do that. They don't want to accelerate the depreciation forward. Maybe they don't have a track record of executing 1031 exchanges. We've done 8 in this very challenging market. Also, do they pass through all the tax benefits to the investor on a pro rata basis? Okay, I've seen deals kind of like boggles my mind where the operator splits maybe like 60-40 or 50-50 with the investor. It's not a pro rata share. So the investor actually isn't getting all the tax benefits they possibly could from the investment. But kind of digressed a little bit because we're talking about how do we apply these principles to evaluate. Multifamily is great inflation hedge. I can adjust the rents. Okay, hopefully not all of my leases are coming up in May, so I have time to respond throughout the course of the year to do annual rent increases. And then our interest rates, they popped up a little bit, 4.5%, 5% on these type of assets. So I still have a great inflation hedge, and I can create some interest rate arbitrage. Self-storage, again, capital preservation, still the same criteria that I'm looking at with the markets. Cash flow, we're seeing great cash flow in the core plus, and value add assets. Probably leaning more towards those core plus type assets. Equity growth levers, we still have the ability again to create good net operating income bumps with moving rates to market rents, operational efficiencies, and adding additional streams of income. This is still another thing when you talk about equity growth is that this area, the self-storage, is still ripe for market consolidation. So that's fantastic as well. We've got our tax benefits that we can take advantage of. Self-storage, the tax benefits, unless it's has a development component, like where you're adding more units, significant number of units to the property or building it ground up, those tax benefits, are a little lower because the depreciation schedule is 39 years, not 27 and a half. It's a great inflation hedge because I can actually adjust rents monthly to what's happening in the environment. And again, I've got good interest rate arbitrage. Express tunnel car washes. I mean, I can't say just car washes, right? That's not what I'm saying. Not your coin operated car wash or the car wash that's attached to the gas station. But for me, I'm really liking the express tunnel car wash business. When I overlay these 4 principles and the 2 amplifiers, again, I get a lot of, it really checks the box, especially if I'm paying attention to investing in growth markets, making sure the car wash, whatever car wash I'm investing in, actually buys the underlying land. That way the operator can control all expenses on the project. Cash flow. Express tunnel car wash businesses, I can manipulate that income pretty readily through a subscription model, and I can adjust those rates. I'm kind of skipping ahead to the inflation hedge. I can adjust those rates pretty readily monthly to month to respond to the environment. These type of assets have a high year 1 depreciation because it's actually book depreciation, it's business depreciation. So I can take all the mechanicals and depreciate that in year 1, and I can still take advantage of bonus and accelerated depreciation. Hotels, as you can see here, hotels are a good one too. It still adheres to my 4 pillars of conservative investing and my 2 amplifiers. Here I put in that, capital preservation. When you look back over COVID-19, the limited services space, I'm not talking about your wedding venues and conference centers. I'm talking about your event centers. I'm talking about like your Holiday Inns, your Marriotts. They did very well, especially if they were leisure driven in an area that had where corporate travel is coming back. Branded hotels might edge out independent hotels just a little bit, but they're both very viable. Again, cash flow, core plus assets are cash flowing very well still. The equity growth on this is, pretty strong because they've been undervalued since COVID-19, whenever travel really was impacted. Tax benefits, you still get to take advantage of depreciation, 1031 exchanges, bonus depreciation, accelerated depreciation. And as an inflation hedge, I love them right now because you can actually adjust rents daily and sometimes even the middle of the day to respond to the market and capture the inefficiencies in the market. And we're still seeing good interest rate lending arbitrage on this. Now, there's a bit of a cost, right? If you don't learn how to actually adjust, invest based on principle, right? Adhere to these principles. You might have issues with building your portfolio. Now, I am not going to batter, some of these other assets too hard. I'm just going to show you the reality, like how these stack up against my 4 pillars and my 2 amplifiers. So cash, year to date, the new inflation numbers were put out. We're actually at 9.1% inflation, not 8.6. But cash, there's no capital preservation, no cash flow, no equity, no tax benefits, no inflation hedge, and you can't leverage it. So it's kind of loses across the board. Gold, it depends on where it is in the market, but a lot of people think that it's actually an equity builder. It's really not. It kind of teeters between an inflation hedge and a preservation hedge, meaning it just preserves the value. Whenever you trade cash for gold, it's just going to keep that cash's value as the cash depreciates. Okay, so but again, you can't cash flow gold. You can't equity growth is not really there. There's no tax benefits to it. You either get the inflation hedge or the capital preservation. I put it in the capital preservation category, and you can't leverage it. Cryptocurrency, Bitcoin's taking quite a hit this year, depending on which one you're looking at. It's down about 56%. We were hoping, everybody was so hoping that Bitcoin was going to be like digital gold and be able to preserve capital and create that inflation hedge. But if you're holding Bitcoin directly, as you know, that has not occurred. You can't cash flow it. You do get equity growth. Okay, that can happen. We've seen it happen. But there's no tax benefits. If anything, that the IRS is trying to figure out who has Bitcoin and tax them on it. There's no inflation hedge, and you can leverage Bitcoin to buy other assets, but it's difficult. Okay, that market hasn't been mastered yet. Paper assets, stocks, bonds, and mutual fund, S&P 500 up until a couple days ago was down about 20%. Capital preservation, I gave it a no. Really, I should be fair. If you don't sell your stocks, bonds, and mutual funds, you haven't lost your capital. Most people in the market cannot hold on to that thought process, and they sell, therefore they lose their capital. You might get a little bit of cash flow, maybe 1%. Out of some stocks, maybe 2-3% out of some value stocks. You can get large bumps in equity for sure. Really, there's not many tax benefits in majority of stocks, bonds, and mutual funds. And again, there's no inflation hedge, and you can't leverage them. Secured notes, that's another thing. I love investing in notes. Year-to-date performance, very challenging, right, to understand like where we are on that. But really, when we overlay these principles and rules, preservation, you might have preservation. I've actually seen a lot of people, recently have their notes paused because people are trying to, especially during COVID, trying to figure out how to pay the note. It does create cash flow. You don't get any equity with it. You don't get any tax benefits with it because it's generally 1099 or box 1 K1 income. You don't have an inflation hedge, and because you can't adjust that note rate, and then you don't have any leverage. So again, I just wanted to show you, like, when you apply these principles and these rules, and again, this is a big long section of what we're covering today. This is why I actually look to these asset classes to build my wealth, is because I actually can check the boxes in all these areas and continued, no matter what that asset's doing, I can get paid in multiple ways in order to invest and grow my wealth. Now, I see a few other people kind of like jumping in here, guys. We have one more section, and then I'm going to cover, open it up to Q&A. If you're just now joining us, you are going to get the recording of this. So you can feel comfortable, rewind, watch it as many times as you need to. But in this section about how to invest your wealth, we covered the 4 principles: capital preservation, cash flow, equity, tax benefits. We covered the 2 amplifiers, how to use leverage, how to find inflation hedges. So we're at 7, okay, principles. 6, 4 plus 2 is 6, guys. The 7th is making sure that you're investing with an expert team, especially if you're investing passively. Make sure it's an expert team that has deep knowledge of whatever strategy you're investing in, has the track record of what you're investing in, has the ability to secure the credit and lending, all right, has the ability to reliably pool investor capital and to close on the deal and manage the asset, and has that team there to work on your behalf. That is the only way you get your time back in actually true passive income. All right. All right, let's take a big breath. All right, I want to encourage people to go to the Q&A box because we've covered 3 sections: how to create wealth, how to keep wealth, how to invest wealth. And now we're going on to our last section, how to pass wealth on. And I'm sure there's questions that have come up. You guys start kind of percolating them and populating the chat box, and I will start answering those in our Q&A section. All right, but as we're talking about how to pass wealth on, there's 2 things we really need to pay attention to here. And it's 1, how do we execute your plan, build your board? And then I want to also cover why most people fail at creating multi-generational wealth, because there's one thing that when somebody's plan fails, there is generally one big reason why, and it's a common thread. All right. Now, I alluded to it earlier. It's called the CYA plan, making sure to put together your plan and then execute on it. Now, guys, if you're just joining us, this is not the full plan, the blueprint we've been talking today. This is just one little sliver of the pie. But when we're talking about the CYA plan, I want you to take a screenshot of this. And when you get off tonight, maybe tomorrow morning, block an hour and start hammering this stuff out. I promise you, you will feel more comfortable with your, should something happen to you, if you have an executor or executrix or a trustee on any of your assets, if they know your plan, they're going to feel so much more comfortable that they understand what your wishes are. But let's dive in. Okay, these are just the bare bones basics. If you have any sort of checking, savings, retirement accounts, I want you to pinky swear me tonight that you're gonna, if you don't have them already in a trust or or beneficiaries designated to them, that you're gonna go put paid on death beneficiaries on those accounts tonight, tomorrow morning, and get that done. Okay, this will help keep those checking accounts, those savings accounts, those retirement accounts out of probate. Okay. If that is not done, those assets now become public knowledge to any creditor or predator out there should something happen to you. Okay, we don't want that happening. So make sure wherever you can, again, pinky swear me, you're going to go put those paid on death beneficiaries on your accounts. Number 2, okay, this is not an exhaustive list. This is just to get you started, right? Make sure you're going to create these separate lists, these 4 lists, and store them with your living trust. Now, if you don't have a living trust yet, guess what you need to do? Remember our protect your assets section. You need to go get a living trust, or at minimum a will in place. Okay, ideally, if you have kids, get a living trust. All right. Make sure you store a list of where all your accounts are, what type of account it is, and who the beneficiary of that account. Remember, in step 1, you just put paid on death beneficiaries for all these accounts. I want you to create a list of where all these accounts are. You don't have to put the account number. You don't have to put the dollar amount. Maybe you just put the last 4 digits of the account, but you just have it all listed out. That way, if something happened to you, your executors, executrix, trustees actually have a list to go through. Now, I'm going to tell you why I now have this list. For those of you who joined at the very beginning, I've settled 3 probates, 2 living trusts. The last probate was my mom's, and it was bad. I mean, even just having her pass away was very devastating to me. However, my mom suffered from dementia, and when my husband and I went to her house to start, trying to figure out just what was going on, even just to find the will, My mom was very meticulously organized. However, she did not put paper in filing cabinets or in boxes. They were in piles on the floor, but everything was organized. Everything was very neat. We could find it. But it was an incredible amount of work for us to find all the different accounts that she had. No beneficiaries had been designated. And more importantly, I actually didn't have a lot of the contact information. It took my husband, he went through majority of the paperwork. It took him 3 days to locate everything. Okay. I encourage you. That was one thing that I'm like, I am not going to put my daughter through that. I'm not going to put my family through that. Create the list. All right. Point number 2, make sure that all assets are listed on this list. Okay. Maybe you've got, rental properties, or you have cars, or you have syndications that you're invested in. Okay. Make sure all of those type of assets, right? Because they don't have an account number. Make sure they're all listed out, okay? And then the associated contact to them. So like if you have rental properties, list your property manager contact. If you have syndications, list the operator contact, right? Again, making it very easy to make sure that all these are identified. Now this third point is gonna sound really weird, but if you have personal utilities for your property or like for rental properties, make sure those utility accounts are listed out with the phone numbers and the account numbers, or at least the last 4 digits, and the contact information. If you have an executor or executrix on your property, think about putting them as an interested party on your account. Should something happen to the property, you're incapacitated, or heaven forbid, pass away, they can actually do things on the property. I'll tell you a story. When we were dealing with my mom's house, one of the sprinkler broke. Okay, sounds like very, it was like a pipe in the sprinkler system. Sounds like pretty easy to fix. The problem is, I was in Colorado. My mom's home was in Houston, and it was just flooding into the street. And I actually could not even get an emergency shut off because my mom had not listed me as an interested party on her water account. And so that water had to flow for 2 days before the city of Houston actually showed up to turn off the water. That was a huge expense to me. So that's why now I was just like, oh man, we need to list out all the utilities. For all of our rentals, my husband, is an interested party. At any point in time, he can call and manipulate those utilities if he needs to. And consider storing all this information in a secured environment, especially like I like LastPass, some sort of encrypted environment. If you don't like that type of thing, you can kind of skip this step. But LastPass, the reason why I like something like LastPass is I can actually put in all this information, and then nobody can access it unless something happens to me directly, and either they're on my list to get access, or after a certain period of time, if I don't respond for whatever reason, it will then give them access to that information. And I can control it based on account to account level. All right, number 3, most importantly here, again, moving from chaos to order, train your executor or executrix. It can just be a 1-hour conversation, something very simple, low-hanging fruit. What do you want? Why do you want it? And where all these documents are and how they can access them. You actually don't have to hand anything over to your executor or executrix. They don't need to know anything. They just need to know what you want, why do you want it, the reason why you want it that way, so they can execute on your behalf, on your wishes, and then how to access everything. Where are the originals on everything? Okay. So my grandfather, when he passed away, my dad's father, my dad had suffered a very debilitating medical condition. And, my grandfather thought if he passed anything on to his son, it would just be, that it would probably go into bankruptcy along with my dad. So he chose not to pass anything along to my dad. At the same time, though, his lawyer advised him that, to also cut out my mom and or remove my mom from any sort of potential, like whatever, shares that, would have gone to my dad, they would have gone to my mom for this very reason too, that she would be like saddled with all this debt. And that if my grandfather, heaven forbid, passed anything on my mom, that, she wouldn't get it either, and wouldn't have to hand it over to creditors or predators. The problem is that he didn't tell anybody. He left he didn't tell the executor. There was a letter that was left, filed away in a box that we found 3 years later, explaining all of this. Now, the problem is he never trained his executor to give this information to my mom. That was very damaging to the relationship. Whereas if we just knew that at that point in time, it would have been a much smoother process. So again, I don't know if you have anything like that in your family, but I just really encourage you, be upfront with what you want and why you want it and communicate it. All right, next part in this whole how to pass wealth on, make sure you have your board of advisors in place. You have a professional team of experts, tax planning experts, legal planning experts, financial planning experts, okay? These are the team, this is the team that's just gonna help you kind of keep everything together, keep you well advised of what's going on with various tax law changes and legal changes. I also suggest get a mentor or a coach or both. I have both. And consider this for each level, however you want to build your wealth and create your wealth. At each ceiling of achievement, this mentor and coach and team is probably going to continue to change every time you level up. So don't be afraid to, fire might be a strong word, but make sure, that as you level up, that your team is leveling up appropriately with you. Number 3, get yourself, in a group of like-minded people that you spend time with, friends, masterminds, paid or unpaid. Really, Jim Rohn has a quote that you are the average of the 5 people that you spend the most time with. I'm not saying purge your family, purge your friends. That's not what I'm saying. I'm just saying if you want to grow, put yourself in communities so you can grow. Okay. Now, why do most people fail at creating any sort of multi-generational wealth plan or executing the plan? And it's because of them, okay? And really it's in 2 areas. One, they failed to educate themselves and their heirs, and they didn't take the appropriate action in order to execute. Remember at the beginning, we opened it up. What is multi-generational wealth? It is the ability to not only understand what it is, but to execute properly. So, if you are the transitional character in your family's life, families wealth build, train yourself in those around you. Have them, be the leading learner. Have them train with you on mindset, skills, and networks. We do a ton of training here at passiveinvesting.com. Have them join us on our Tuesday webinar classes. Have them join us on these boot camps. Give them the recordings on this. Invite your family and friends. Take action. All right. You guys have been sitting here. I don't have the clock in front of me, probably for like a solid hour and 15, hour and 20 right now. How many of you are going to actually take the information that you learned tonight and go put it into action starting tomorrow? Not next week, not next month, not next year, but tomorrow. Okay. So make sure that you review that. You're going to get the recording. If all you guys here have registered, so you're going to get the recording, work through the recording. Put together your blueprint. Other things that you can do, write a purpose statement for your trust. Okay. I keep driving home the message of getting that trust in place, especially if you have kids. But this is, again, your opportunity, if you don't have one in place already, to be that transitional character. Tell people, tell your family why you're doing what you're doing. Okay. People don't need to understand what you want. They need to understand why you want it. If you have kids, or older kids, kids in college, or even yourself, make sure you're reading the right books, playing the right games. I have a young child. We've been playing the Cash Flow for Kids games since she was 3.5. My child understood the difference between an asset and a liability at 3.5. Trust me, that saved me a lot of Barbie doll purchases when she was really young. Not to say that that's going to make her turn her into a millionaire, but she has the concept down. Create a value economy, like with your family. We don't just pay for chores. We have a list of things that she gets value, can exchange value and get paid for. Some things are just required. She has to execute on what we call executive ordering type things, brushing her hair, brushing her teeth, making her bed, basic things around the house that just contribute to the family. But then there's other things that she can participate in the business and get paid more because she's adding more value. Record your journey. This is one thing that I did. I have a coaching company called Ash Wealth. ASH are the initials of my daughter. Okay, a lot of people thought it was like, oh, we're going to burn everything down, or maybe it's the ash tree. No, it was, I named it for my child. But what I did is that I started recording my entire journey there. So she would, something happened to me that information was laid out for her, and I can pass it on. Maybe you can do that, through, playing games, creating a value economy, bringing your kids into your business. If you're investing passively here at passiveinvesting.com, have them walk this journey with you. But record your journey for yourself and for your heirs. And more importantly, create a space to fail. I know for myself, I'm a recovering perfectionist. That's how I was raised, and failure was just not an option. But if my child can learn how to fail with $100 now, or even 1,000 on an investment, that's going to pay off dividends. She can learn those lessons now, as opposed to learning it with $100,000 later, or more, maybe like $1 million. All right. Now let's wrap up. Okay. Here are the core 4 steps. These are the sections we covered tonight. And again, you're going to get the recording, is how to create wealth. Okay. You need to understand how to move that linear income into residual income. You need to learn how to create a rich balance sheet for yourself. That's step 1. Step 2, how to keep your wealth. Okay. Watch out for the 4 horsemen in your portfolio: interest, fees, insurance, taxes, and then learn what you need to do to protect your assets. Step 3 is how to invest your wealth. Okay. Invest according to the 4 pillars, 2 amplifiers, and especially in the 3 assets that can actually help you generate wealth. And then number 4, how to pass wealth on. Okay. Building out your CYA plan, building out your board to surround yourself, in the group that you need to be in order to level up, and then educate not only yourself, but also pass that education forward. There's nothing worse than being that transitional character, building up all this wealth, handing it on to the next generation, and then they have no idea what to do with it. All right, guys, it's been a pleasure. I'm going to check the time, but we definitely have a few moments for some Q&A. So you guys go to the Q&A box and let's get some of those questions answered. I know we got raised hands, but we're in webinar mode. You got to go to the Q&A box. Sorry. So go there and type in your questions. And just so you know, I'm actually